Hello, everyone. I just wanted to let you know that we will probably start in about 2 minutes once a few more people log in. Thanks. Okay, well, hello, everyone, and thank you again for joining today's webinar on guarantee insurance and how it can help you with your loan guarantee requirements on your current or future real estate transactions. My name is Renat Yusupov, and today's speaker will be Daniel Weingarten from LGIS Group. Before I pass it off to him to host the webinar, I'd just like to make a few introductions about the involved parties. Bullpen, the company I work with, Bullpen is the place to hire commercial real estate talent for your business on an as-needed basis. We have a variety of talents, so feel free to check us out at bullpenre.com. And I would also like to thank our sponsor, Texas International Consultants, Inc., or TICI. TICI is a group of companies formed in 1921 as a family office firm. Almost 100 years later, they are now a national consulting firm with partners in 16 states and growing. They are an authority in every facet of real estate and help individual, commercial, or institutional investors with various commercial asset types while specializing in healthcare real estate and capital markets. With that, would love to pass it off to Daniel so he can introduce himself and kick off on the webinar. One last comment, if you have a question, please feel free to submit it through the question box and we will read it off, either throughout the webinar or towards the end. Daniel, with that, I'm gonna stop sharing and I'll let you kick off from there.
Thank you, Renat. First off, thanks to Bullpen for allowing me to speak on their platform, and I appreciate all attendees for taking time out of your busy day to learn about a new-to-market, innovative insurance product for commercial real estate. We're going to initially talk about the current system where the sponsor of a project is signing a personal guarantee for the entire loan and the difficulties and uncertainties behind the collection process. Most individuals don't like signing recourse and prefer non-recourse loans, and our product is another alternative to achieve non-recourse financing. Currently, your only options are the debt funds, which have been growing in market share, but are costly, points in, points out, or you could borrow someone else's balance sheet, or as what we call a country club deal, though a chunk of the deal is also handed over and your returns are minimized. However, most borrowers and developers would prefer to deal with the bank as they are best at servicing their clients by accumulating and distributing capital. We will go over the specific hurdles, including liquidity covenants, balance sheet restrictions, and capacity issues, and lenders wanting a warm body on the line, and more. And then finally, I will introduce our patented solution, commercial property loan insurance, brought to you by Loan Guarantee Insurance Group. This product is designed for all types of developers, though originally designed for those that have been crushing it for the big firms, say Jamestown, Cousins, and others, that have now broken off on their own but don't have the necessary funds on their balance sheet. They have successfully completed several projects but financially can't guarantee a loan. This is also for the seasoned real estate professional who doesn't like signing recourse, though has previously been doing so, but prefers not to risk the wealth that they have accumulated for their future retirement. Here is a real-life example of a capital stack for a future, say, ground-up construction project. The structure, typically through a single asset entity, is put together by the sponsor. This example is a $10 million deal financed with 70% debt, loan to cost, and the sponsor is raising most of the 30% equity into this deal. However, the sponsor typically is only putting 5 to 10% of the entire equity into this structure, sometimes nothing at all, and is usually also responsible for bringing and guaranteeing the debt. So the small money guy is responsible for millions, sometimes tens of millions of dollars, depending on the project size. Banks would require recourse on this structure in any deal with less than typically 45% equity for a ground-up construction project. The leverage could certainly be higher to achieve non-recourse financing for other types of deals that are either stabilized or certain types of value-add construction projects. But lenders currently focus on the borrower's ability to repay and not the feasibility of the project. As drafted in the loan documents, the sponsor is guaranteeing the following exposures for the lender: bad boy carve-outs, such as fraud and misrepresentation of facts; the completion guarantee, which is typically tied to CO, certificate of occupancy, and is the construction risk of the project; and also the repayment/deficiency guarantee, which is the market risk of the project. In fact, there is no difference between the repayment and deficiency guarantee, as the property must sell to determine this deficiency. These exposures are all covered for the lender by our insurance product. There are many problems for both the borrower and the lender that affect whether a deal ever gets done in the first place. But there are also many tedious tasks and challenges through the life of the loan, such as completion guarantees and how completion is actually defined. In fact, you can't actually force someone to complete a project. The sponsor might not have the funds for the liquidity covenant necessary and required by the lender. This is typically 10% of the loan held in either cash or cash equivalents, say T-bills. Ongoing oversight of financials through quarterly reviews are also tedious, and banks rarely, if ever, collect on these guarantees. Typically, attorneys get involved, and there is a discounted payoff, or a DPO. Depending on whether the subject property is located in a foreclosure or a judicial process state, the process is long and contentious, sometimes several years, and costs a boatload of cash for both parties. Again, this process is very controversial, and the only professionals making money at the end are the attorneys. As you can see in the example for judicial process state, this time frame is taking for 39 months as an example, and the lender is still not being made whole. This is a broken system that needs to be fixed. We call, when the attorneys get involved, we call this the dance, because there is typically a lot of back and forth negotiating where the sponsor typically frustrates the collection process. Both sides run up high legal fees, which could end up in a discounted payoff for the lender, leaving them with a deficiency. Sometimes lenders even take the property back based on the valuation of an appraisal, only to potentially further sell the property off at a loss. the delta between the appraised value and the eventual selling price is further eaten by the lender. This makes no sense and is funny why banks even do this to begin with. The outcome is negative for everyone. There is significant time and cost associated with the process, which leads to a ruined relationship and wipes out the deposits for the banks. And if there are two things banks love most, it's deposits and relationships. Nothing has changed in the banking industry for centuries. Going back to the Medicis, personal guarantees still aren't worth the paper that they are written on. Lenders have begun to introduce burn downs as low as 10% upon stabilization. However, 10% of a deal is still a lot of money to the tiny little sponsor who, again, is bringing 0 to maybe 10% of the deal, who is guaranteeing the debt. But again, their funds are most likely tied up in other projects, so not as liquid. Liquidity covenants are the right idea, though incorrectly applied. This is designed to be the emergency cash to fix a problem or if there are cost overruns to pay off. The covenants are hardly ever enforced and are difficult to grab at since a lender still must sue to draw on these funds. Both the liquidity covenant and liquidity collateral kill a good portion of deals before they even get signed on, though the collateral is actually accessible to banks, but is left often required by them. In fact, we were underwriting a ground-up apartment complex in Boston the other week, which had a $6 million liquidity covenant for the $60 million loan. This frustrated the well-seasoned borrower, as this is a lot of money to essentially have on the sidelines. LGIS could have been their solution for this project. Entity guarantees are also back, which was a major reason for the most recent Great Recession, where one entity backed several projects and will eventually leave several lenders without any collections if one bad asset drains the pot. This should be covered by the quarterly reviews of the financials, but is typically not checked. Our solution would be to insure each loan separately to increase everyone's capacity and transfer the riskiest portion of the loan to LGIS. We have an example of the liquidity collateral benefit, covenant benefit on the next slide. Oh, looks like I actually have the wrong one open.
Daniel, if you don't mind, just a question came in. Would you be able to elaborate on, the requirements of local banks versus agency lenders, if there's any nuanced difference our viewers should be aware of?
I think each lender is a little different. I mean, if we're talking about, for Fannie Mae and Freddie Mac, this could be a stretch for them. What we're focused on, and we'll get to this later, is you're not going to change someone's or a lending platform's entirely at first. We're focused more on the community and regional sized banks who are innovative and forward thinking.
Got it. Thank you.
Okay. Bear with me for 1 second, please. I'm going to slide this over. The liquidity covenant financial benefit. This is the example for the Boston deal that we were just going over. I apologize that my slides must be out of order. But as you can see here, the 10% liquidity collateral requirement is $6 million. And over the life of the loan, the delta between the 22% reinvestment rate and the 1.75% T-bill rate over the 3-year period, once backing out the LGIS premium, is $3.4 million essentially. So not only does this pay for our premium, but it also benefits you as the borrower, so you're able to redeploy those funds into future deals. False myths such as we want a warm body or we collect on personal guarantees. These are some of the old school reasons and myths associated with the personal guarantee. This is a counterproductive requirement by banks and never results in a maintained relationship should things go sideways. In reality, these are hardly collected upon, and the overwhelming majority of bankers will tell you that they don't collect on them, but they are still required within the industry. As discussed earlier, there are current alternatives to the personal guarantee, but they are costly to obtain, additional points in and points out, or could also take a chunk of the deal and take away your hard-earned returns. And this, again, talks about the entity guarantee and guarantor that is one pot that is the collateral for several different projects. Finally, we get to the fun part. Hopefully the reason you all are all on this webinar today. LGIS, Loan Guarantee Insurance Services, has brought to market an investment grade rated insurance product to transfer the exposure on the riskiest part of the loan away from the borrower. At the end of the day, we are a credit enhancement and should be viewed that way by the lender. Stepping back, we're taking the exposure away from the lender. Not even the wealthiest of investors are investment grade rated, not even Mark Zuckerberg. CPLI has been in the works for over a decade. Designed by David Eichenblatt, my boss and the LGIS president, he himself has over 30 years of experience in commercial real estate acquisitions and development throughout the nation. This is a purpose-built product, which has had significant input from lenders over the years, as you all will see within the policy, which I will share the link with y'all at the end of this presentation, including during the 10-year process, obtaining a process patent on the product. There is nothing else like this out there. As deals started to outgrow his balance sheet, David was forced to go out to the debt funds to achieve non-recourse financing. Most people would agree that they either do not ever or do not like to sign a personal guarantee. But again, they had no other choice. Though this is the first new insurance product in cyber, this is not that new of a concept to banks. Lenders are familiar and are already engaged in other risk transfer products, PMI for residential and SBA for C&I loans. Why not now for commercial real estate? So how does it work? And what are the parameters? Focus on the major property types: apartments, office, retail, industrial, storage facilities, and some hotels, and storage facilities which have increased in demand significantly over the past several years. Of course, mixed-use projects are also included here, and so are the many subcategories of these property types, such as cold storage or medical office properties, for example. The insurance coverage is for a 3-year term or less, which is typically the amount of time to build, fill, and stabilize a project of $50 million or less. We target loan sizes of $5 million to $200 million. The larger loans could also be just for the liquidity covenant requirement. Again, typically 10% of the loan that must be held in cash or cash equivalents. For example, T-bills today are around 1.75%, and going back to the liquidity covenant financial benefit slide that I slid in there previously. Should these funds be released into other commercial real estate investments earning 20+%? Again, coupled with our insurance product, with the full budget and more contingency, this should wipe out the need for the liquidity covenant, and which we will review on the next slide. Actually, that might be coming up. So CPLI covers the riskiest 10 to 40% of the loan, which includes a minimum 2% deductible for moral hazard purposes. Here's my liquidity covenant example. Again, going back for the deal that we were looking at in Boston, you can see that the difference between the 22% reinvested rate and the T-bill rate of around 1.75% is $4.5 million. Once you deduct out the one-time LGIS premium, It's a $3.3 million benefit. In fact, we already see this as we have a bank on board in Alabama that is no longer requiring the liquidity covenant with our insurance product. Going back to the initial capital stack example that we saw in one of the first slides where there was a 70% loan to cost project. Now, instead of the sponsor guaranteeing the entire loan, LGIS steps in and insures the riskiest 40% of that loan, or 28% of the entire project, less the 2% minimum deductible. The deductible here is 2% of 70%, which equals the 1.4% as shown in the diagram. There is no need to insure the entire loan, as this coverage brings the lender's exposure down below the 50% threshold, where most lenders will give you a non-recourse loan. Since their exposure is less than 50%, this example brings their exposure down to 42%, giving the lender a low probability of a loss given a default and allows them to sleep better at night and not have your foot on the neck. We have a 4-step process to review a project and we'll eventually submit a binder at closing. You can submit your project to either my email address, which I will give you at the end, which will be shared later, or through our website, www.lgisgroup.com, on the Contact LGIS tab. Again, before we go further, I want to make sure that we touch on what this costs. This is a one-time upfront cost to be paid at closing to LGIS between 1.5% to 3.75% of the entire loan amount. Lots of variables are taken into consideration on where this falls, including the sponsor, feasibility of the project, the equity in the deal, the property type, and whether it's a ground up or stabilized asset, and more. We will dive into the process now. Step 1 is the preliminary review. Typically, LGIS, we want to underwrite this project within a 24-hour period. Information typically put together in a great lender package by either, say, a CBRE, JLL, George Smith Partners, and so forth, should be sufficient for our review. Other items might include market studies, pro formas, Argus models, and other due diligence reports, which are helpful for us to get our arms wrapped around the project. LGIS will deliver a preliminary term sheet once reviewed and approved to insert into the lender package, showing how much of the loan is being covered by our investment grade rated product. Your mortgage broker or yourself would take this term sheet to your lenders to satisfy and replace their need for a warm body, as our loan will now be backed by an investment grade rated insurance product. Again, this is a credit enhancement to the lender, and they should offer you better financing terms. The timing to get us involved is before you source your debt, because if you give lenders the option, they will always go with the conservative approach, which they are used to and have been going with for many years. Once approved, step 2 is to fill out an application, which is attached to our policy, along with the application fee. Continuing in the policy lifecycle, step 3 is when LGIS will perform a full underwriting and approval process across 10 business days, where we like to complete our own due diligence. We don't want to just take for granted the information in the package. We will meet with the local economic development department, planning and zoning department, and so forth by flying out to the location. The other reason for this step is the approach LGIS takes in their underwriting, which is from an equity investor position. Again, we want to get the full picture of the project and understand the risks that we are taking to confirm it will be successful. LGIS cares most about and underwrites for who the sponsor is and what their background is, and the feasibility of the project, where lenders are mainly focused on the borrower's ability to repay the loan. And after all that, step 4 is issuing the loan policy at closing and collection of the one-time upfront premium. The lender is now covered on all exposures during the policy term. Bad boy carve-outs, completion guarantee, where, as mentioned previously, you can't force someone to complete a project, but LGIS would cover damages for an incomplete project, and the repayment or deficiency guarantee. However, LGIS does have the right to subrogate and go after the borrower if the default is stemmed from a violation of a bad boy carve-out, though this is hardly ever the case and is extremely difficult to prove, and most lenders that we have spoken to cannot recall an instance where this was due to a bad boy carve-out. During the policy lifecycle, LGIS stands behind the lender and only has to be copied or CC'd on communication for monthly reviews, loan draws, inspection reports, and so forth. Our goal is not to get involved and be another party at the table, while everything is going good. However, if there is an issue that can't be worked out, then the borrower default claim is, and the stake is put into the ground, which will need to occur during the policy term. This is when LGIS does get involved, as we want to mitigate our risk and losses. LGIS, we hope for a quick resolution since both properties aren't exposed anymore for further losses. It's really a dual trigger process. The lender obtains title of the asset in question, most likely by a deed in lieu, and there is a foreclosure sale. However, we also allow a short sale, which greatly benefits banks so they don't have to put the property on their books. Banks also get penalized greatly if the asset is on their books for greater than 1 year by the FDIC. So it's the goal for everyone to have a quick resolution and maintain that relationship going forward. No longer is the borrower's livelihood put on the line. Called a claims made form, the settlement can be completed whenever. But again, the claim must be made during the policy term. The math is simple. If the net sales proceeds from a foreclosure sale or a short sale is less than the outstanding loan balance, then there is a deficiency. And LGIS pays that deficiency within 60 days. And quick resolution, everyone is made whole. This is a win-win for the borrower and the lender. No longer is the lender's foot on the borrower's neck, and they're no longer threatening financial ruin. We won't dive into this example deeply, but what we are comparing here is a loan backed by LGIS versus a non-insured loan from the lender's point of view. The benefit here is eliminating over $2 million of exposure. Now, where does LGIS get their backing, and who is insuring this new form of insurance? State National Insurance Company. They are AM Best A rated company that is a wholly owned subsidiary of Markel Corporation, who is S&P A rated. New York Stock Exchange Company, their ticker symbol is MKL. That is who is backing this insurance, as no one wanted to buy Daniel Weingarten insurance or David Eichenblatt insurance or anyone else on our team. This gives LGIS a national presence and provides lenders a competitive advantage for approving of this new product. For example, we have looked at deals in Las Vegas, Boston, Houston, Dallas, and of course in our home base of Atlanta and more. There are many benefits to the lender listed here, which will be discussed on the following pages. Given the investment grade rated credit, LGIS is a credit risk mitigation tool and was one of the main reasons for the partnership with State National. It allows capital relief for banks so they don't have to set aside as much funds into reserves for each loan that they give out, and is a strategic move to raise cheaper equity. This improves how lenders estimate a loss by almost eliminating the loss given a default metric and decreases the collection time with the certainty of being made whole. We also have an example of this in the appendix, which we won't go over today, but will be in the slide deck that will be sent out to everyone after this webinar. This lowers operating oversight and procedures, but will eliminate and lower costs on the oversight typically needed on a loan. No longer will this process be contentious and relationships ruined as the eventual outcome if there is a default. LGIS ensures that these relationships stay intact in the end because no one's livelihood is put on the line, and everyone works for a cooperative solution. An additional benefit is going back to the deposits, which banks care a lot about, and almost some say love more than air. LGIS will leave a portion of the premium in the bank for the term of the loan to increase their accounts. And this will also allow them to do more deals. This is a graph just showing many benefits to both sides, including resolution time, costs associated, and the probability of collection. And of course, capital relief and the credit strength of LGIS, which is a major benefit to banks to keep them competitive, and as debt funds are, as mentioned previously, are even more increasing their market share. Now, what is the benefit to the borrowers on this webinar? First loss position risk is transferred to LGIS. You should achieve lower financing terms given the investment grade rating, as banks have an internal rating scale. This is at the top, and most borrowers are not investment grade rated, and balance sheets no longer restricts capacity for future deals. This unlocks tied up cash and liquidity covenants and enhances the relationship between you and the lender so you can do more deals. There's a common theme here. Do more deals and transfer the risk. How can banks use this new tool? And these benefits have all previously been discussed, such as capital relief, certainty of collection, and hopefully gives them back some of the market share that debt funds are taking. It provides them with a competitive advantage and reduces the time for a resolution and allows them to avoid significant carry costs, penalties, and legal fees. How can borrowers use this new tool? This is a scalable business model, which is no longer restricting you by your balance sheet. Lenders are already seeing the benefit this provides. The product was embedded for the professionals, again, who don't have the balance sheet but have a successful track record in evaluating a feasible project. Our policy can be found on our website at www.lgisgroup.com. If you go to the login tab and type LGIS client into the password for access, you'll be granted access to download our policy. Feel free to review if you can't sleep at night and or forward to your attorney for their legal advice. Below is our contact information. Feel free to reach out with any questions to discuss not only our product and how it works, but also a potential project you're working on that might benefit from this credit enhancement. I know I kind of ran through that fairly quickly. Given that we have this is an hour-long webinar, I figured since this was a new product that there would be a lot of questions that we can help answer. And I will hand it back over to Renat, and we can go over some questions.
Thank you, Daniel. Great job. Yeah, thank you so much for that presentation. We have a few questions. I'll just read them off. Let me know what your thoughts are. Question number one, when is the best time to submit a loan guarantee concept? Is it before or after you identify a lender?
It is before you identify a lender. As mentioned previously, lenders will always go with their bread and butter to get the deal done. Even the lending officer. The lending officer's job is to make loans. Basically, the best time to get involved is when you're putting the lender package together and going out to source your debt. That way, you get them on the front end and allows time for not just the lending officer, but also at the end of the day, the chief risk officer to approve of this credit enhancement. And this is a new product that some or most lenders may have not heard of yet. And the best approach is to bring them a deal to review with. Most bankers that we have spoken to have all said, all right, we get the concept, we understand how it's going to benefit us, but let's see it with a real project. And I believe borrowers also feel that way, as they want to input the cost of our insurance into their model to see how that affects their returns. But with the benefits of the better financing terms, which is a small benefit. 2 is you might even get more debt, maybe 5% more debt dollars. That's a pretty good impact on offsetting the cost of our premium. But 3 is the liquidity collateral example that we went over previously, where that not only pays for our premium, but is a financial benefit, or 3 or 4 times the cost.
Got it. And there was a second part to the question. You kind of hit on it, but maybe if you have any other details. Does it make sense to approach you at any stage before the full acquisition has been done and before you're actually going out to lenders, or to loop you into that process of the acquisition? Let's say you have a property in mind, or you have a project that you're trying to underwrite. Yeah,
I mean, any time at the beginning before you're going out and sourcing your debt, typically, maybe just as you get the property under contract or when you're submitting your bids. The goal for us, again, is to underwrite the project or the opportunity within a 24 to 48 hour period. And so what's helpful for us and the CBREs and JLLs and those of the world put together these great packages that provide us with all the information to underwrite the deal. Because what we care about, in addition to the sponsor and the feasibility of the project, is at year 3, typically with a construction loan or a mini perm loan, after year 3, can you be taken out by refinance or by sale? And so what we're looking at is, can that be done, and can the project be built, filled, and stabilized by that point?
Got it. So once again, you kind of hit on a little bit of the next question, but I'll still ask it just in case there's anything else to elaborate on. The question is, how easy is it to tell the concept to the lender's underwriter? With that, if you have anything you want to point out in terms of any kind of nuances of education or explaining your program that you find would be helpful for sponsors to know ahead of reaching out.
Sure. Yeah. There's nothing better than doing homework before going out to your lenders. But what we like to give out is the preliminary term sheet. We're also happy to get on phone calls and introduce the product to the commercial lenders, and again, specifically the chief risk or credit officer. And also, we have tons of materials on our website, including case studies, our policy, our brochure, and a couple other examples, white papers. Please check out our website. There's a lot of information, but again, we're happy to discuss with your preferred lenders.
Great. And we've spoken a lot about the sponsor, a little bit about the lender, but since we may have a few lenders on the line, would love to ask a question from their perspective. You mentioned qualitatively the benefits with regards to FDIC requirements for lenders. With regards to the Federal Reserve, obviously they're putting it out at lower leverage, so they're really meeting that lower leverage requirement. Is there anything else to be, that a lender should be aware of in terms of the benefits they will get from this program or pairing with this program?
No, I mean, I can just harp on what was previously sent. I mean, this allows them to sleep better at night, and every lender that we've spoken to, it's almost comical at this point. We asked them how many of the personal guarantees have been collected upon, and they throw up a big zero. The capital relief is a big benefit for some of these community and regional sized banks that, again, it's costly to raise equity. And if you don't have to put as much funds aside on each deal, that is the strategic way to raise more equity and allow you to be competitive while at the same time mitigating your risk. This is a credit risk mitigation tool. And so banks are already doing this for residential and C&I loans. And we're getting a lot of good traction from the lenders, and certainly the borrowers who don't like signing personal guarantees are, chomping at the bit for this.
Got it. And this question is really for me and more out of curiosity, if you have a data point on it. Do you see more sponsors or lenders reaching out to you as of now about this program? Because it obviously benefits both, so I'd love to hear if one is more proactive in reaching out and using the program than the other.
Yeah, in fact, it's the intermediary between the two. It's the mortgage brokers. The mortgage broker's job is to, source the debt and they're working on the deal on also maybe the equity. So they're looking at alternative, innovative solutions that are not as costly to their clients. Debt funds are fairly expensive and they have a place in the world. But we've actually done an analysis comparing LGIS plus a non-recourse bank to live deals that include bank non-recourse and also debt funds or also a country club deal where your returns are going to hit. And LGIS has overwhelmingly been a better return than those alternatives. So mortgage brokers are the best people for us to get in touch with. And they also put the great packages together that are helpful for us in our underwriting materials.
Got it. Well, thank you again. That is it for questions, unless anybody has anything to chime in. I will obviously interrupt myself. Otherwise, again, would like to thank you, Daniel, and your team, TICI, and everybody that came online to listen to the webinar. Just want to make a quick announcement. We're going to be doing our next webinar in November, co-sponsored by 10X, so we're really excited about that. You will all receive, everybody who's on here will obviously receive an invitation once it is out. With that, again, thank you, everyone, and I think we can wrap up here. Thanks.
Thank you, everyone, for your time.